Hello and welcome to Trading Growth and Value with a special class today on trading bullish trends with protected puts and callers. Don't normally get an opportunity to talk about that on Wednesday, but this is a special class where many of you are invited to actually join us. Not for just a one-off session. This is a weekly session we do. Our main focus we normally talk about is trading growth and value in terms of stocks. Today we'll actually include a discussion on options. We'd like to welcome all of you here today. BJ, Roger, Jim, Josh Pink, Will. We also have Ben watching with us in the chat. We got Texan with us and many others. Good morning to all. Now, this is a live session. Just know that if you're watching this on the recording, welcome to you. Anything that we show in terms of charts or anything like that, if special, I'll make sure to actually include in the description of this video. Now, remember, Ben and myself, we do post educational content on X. There is my handle, at James Boyd CS. CS for Charles Schwab. Ben will actually post his handle in the chat that we can click on it and follow Ben as well. Now, just real quick as we get started, some of you might not know, but we are on X, so this is being broadcast via YouTube. If you went to youtube.com, you typed in the search field, Trader Talks Schwab Coaching Webcast. These are webcasts that we actually post online and also are broadcasting live. So you don't have to be on a computer. You could just be on your phone. You could be on an iPad or a computer, whatever, okay? That's the nice thing about YouTube. Don't have to be on a computer. Now, the other thing is, quick mention is if you said, well, hey, wait, is this one-off class or is it like you have a series of classes? Well, let me send you this link first, okay? This link is going to get you to this page. If you have not subscribed, feel free to subscribe. It's free. Also, you can see all of our past classes that we've actually done and also playlists for those classes. Now, the second thing I want to show you, if you said, well, what other classes might you teach? Okay, this is going to give you the calendar for the month of July, and you're now going to see that this is one of many classes we teach at Schwab, and you're going to now notice that we are right there. Growth and value stocks, trading bullish trends with protective puts and callers. And notice the focus is stock, but sometimes the investor might say, I want to actually have some protection, okay? So that's where we are here. So if you said, well, James, so if I had that link, could I maybe go to the class here? Yes. Could I also go to the advanced charting on Friday? Yes. How much does it cost? Zero. And if we take a look at this, could I go to tomorrow's short verticals? Yes. Okay. Could you also click on yesterday's classes and see the recordings of those? Sure, whatever you want. Okay, now let's actually go in. So some of you just want to make sure you're aware of some of those quick, easy wins. Now, first off, when we talk about stocks, which we will, we're also going to bring up options on today. And remember that options carry a high level risk, not suitable for all investors. Now, not all options are the same. Okay, so that's what we first want to understand. When we talk about, let's say, the information I talk about, I'm going to give it for general informational purposes only, should not be considered individualized recommendations. So we're going to do about maybe 2, 3, 4 examples here today using these protected puts and callers. Will show that. Now, as we go through, this is not a lecture. Do I look like someone's going to give a lecture? Absolutely not. I don't do lectures, okay? I don't even do slideshows, okay? So we teach lively sessions, which means you have questions, we interact. Okay, so that's just imagine we're having a conversation here. Now, also remember that our examples would be done on the Paper Money software application. When we talk about investing, we know investing involves risk. And also when we talk about, let's say, if we bring up things like dividend paying stocks, know that the company may reduce or stop paying dividends. They could also increase them. Okay, so the moral of the story with dividends is they're not infinite in time, could change based upon the business conditions of that company. Now, let's go ahead and actually just hop right in. And what I want to first talk about just real quick is the SPX, okay? Now, the SPX, if we look at the S&P 500, it kind of looks like it's been a little bit more neutral. Fair? Okay. Now, it's so interesting to me because we want volatility. We want the price to go up. But sometimes every day is not an up day. It's just not. Okay. So you might get 2 or 3 days up, and then the next 1 or 2 days it goes down, right? It's just trading, okay? The trend on the SPX has really not changed And this is why there's different strategies. Now, most people don't really know this because they just buy stocks, ETFs, or whatever they are, just hoping over time they go up. But if you're someone that likes to trade more shorter term to intermediate, there's different types of strategies, even for shorter term and intermediate, not just trading direction by itself, hoping it's always going up. Now, if we talk about this, what I want to do is first bring up kind of something that also happened overnight, which you obviously know by now. We saw crude oil go back up. That we're looking at the oil prices for August. We saw oil prices go back up. And what does this matter? Well, we saw the market Dow Jones push down as the oil prices actually went back up. Now, one thing we've kind of said before is that the only constant is that it's not constant. Okay. In other words, there's always probably going to be things that come down the pipe as far as news that causes prices to move. If you're still surprised by that, don't be surprised by that. It's like running a company, it's like running a family, and so on. Things happen. Get over it. Okay. So we know that if welcome to the trading day, there's going to be something in the world that's good and bad. Okay. Now, that movement, though, causes potential opportunity for learning, strategy, but also maybe trying to potentially benefit from that. Now, let's actually go to just real quick and let's get into the meat and potatoes here. So first off, when we talk about this trading bullish trends with protected puts and collars, I want to kind of break this down. So first off, when we talk about risk management, okay, so when I talk about risk management, and I think if we kind of said like risk management, number one is asset allocation. Okay. What does that really mean? It's not putting all the eggs in one basket, meaning, James, all my money is in stocks, or James, all my money is in technology. That's not asset allocation. That's putting all the eggs in one basket. You would be shocked. I think it's probably more people than not that just got to put all the eggs in one basket and they're surprised when things go down. All it does is exposes the strategy of number one, asset allocation. This is why people spread capital to different asset classes. Stocks are not the only asset class. And second, they're not putting all their money in one sector. Okay. Now, second thing, position sizing. Okay. Now, this is kind of another. Now, what does that mean? Well, if the investor has an account, let's say $100,000, and they say, look, I'm not going to invest more than $10,000 in a position. What does that mean? Their whole portfolio is not in one stock. Okay. Now, if you ask me, you ever heard that little saying that says common sense is not common? Okay. Okay. All right. Just tell me if you get it by now. Okay. Now, here's the thing. I think we're all guilty of kind of doing some things we wish, geez, I wish I wouldn't have done that. If you actually don't do one and two, you kind of did it to yourself. Okay. Just, you got to take ownership. Now, we've all done that. Hopefully, you learn from that and we're ready to move on. Now, number three is actually stops. Okay. Now, when we talk, you know what stops are, right? You have something and you say, hey, if it goes to this price or lower, sell it. These are three common ways of risk management. Now, does the investor have to do a stop? Well, they could. There's pros and cons about that. But some people might say, James, I don't really like stops that much. Okay. If the stock goes down to that price or less, it sells the stock, locks in that gain or loss, right? They might say, I don't really want that. Know about that, but I don't really want that as my strategy. Well, what's the alternative? Well, welcome to today's class. Well, the first thing is we're going to label this as protective put. Okay, protective put. Geez, I'll just protective put. And we're going to also include with this, number 5, a collar strategy. Now, let's get some of this out before we look at our example. So if I said something like married put equals buying a stock plus a long put. Now, when I say long put, what does that mean? It means that we're buying a put. What does that mean? What that actually means is you have a right to sell the stock at the strike price. Why would you want that? Well, maybe you want to actually just protect the downside. Okay. You want to define the risk. Okay. That's a major. And also, what you're doing is you're wanting to actually maybe not have the position at risk as much to price movement. So, number one is you have the shares of the stock. And number two is you bought a put, think protection, which is the right to sell the shares at the strike price. Now, a married put is where the investor is buying the stock in a long put and it's at the same time. Now, if I said something example given like a protective put, what does that really mean? Buying the stock first, okay, and later buying a put. So the difference is in timing. Why would someone do a married put versus a protective put? Well, a married put is just kind of like what we're leading to is we're not trying to time it. Okay. And by the way, we're going to do examples of both. When we talk about protected put, someone actually might buy the stock thinking the price might go up and then later put on the put where they expect the price to go up to an area of resistance and sellers to sell. Now, what I want to do just real quick is when we talk about, for example, now, by the way, when you went to college and even some of you had business classes, how many of you actually had a class on risk management? How many of you actually had a class on how to protect your assets? I'm telling you, it's cricket, right? Not a whole lot, okay? No one really explains this. Now, the person that's presenting this to you has actually had practice 30 plus years of this, 30 years, okay? A lot of people talk about the strategy, but actually have never really done it. Now, if you followed me over the last 20 plus years, 25 years, etc., I've been in the company since 2003, so 23 years, you know that this has been a topic I've talked about for darn near 25 years in this ecosystem, okay? Now, what I want to do is let's kind of go to this. Now, by the way, if someone actually says a protective put, this strategy is really done when we actually have volatility, okay? That's probably between 15 and 24. So without even looking, if we actually said, hey, when would someone do a protective put or a married put? And I'm going to kind of put this right here because we talked about the differences there, married / protective put. It's usually when the volatility is between 15 and 24. Can anyone tell me what sectors typically have lower volatility? What sectors usually have lower volatility? And the answer to that question is going to be probably healthcare stocks, probably going to be utility stocks. I'll put staples first. Okay, staples. Probably going to be, let's say, utilities. Probably also going to be real estate. These are the majority of probably what we're going to be finding. Now, if we looked in technology, things like that, could we, discretionaries, could we find some stocks that have a volatility of lower amount? We could, but it's going to be more the minority, okay? Now, the biggest actually thing is, well, why does it matter? Well, as you're going to see in just a sec, the higher the volatility, the higher the cost. And when I say cost, I mean premium. And you're going to see why that matters in just a sec. Now, are there any other two sectors that I missed where we would say, hey, we want to keep an eye on this? Yes, we would say financials, and I'm also going to asterisk industrials. If we said what are two sectors on the outside of that that also kind of might be in that realm where they might actually have maybe a little bit lower volatility, where you might consider buying the puts? The answer is financials and industrials. Now, let's go out and practice for just a second. And what I'm going to do is, I'm glad you said that, Evan. Now let's actually do this. So we kind of set it up. Let's actually go out and practice. Now, the good thing about coming to a class is we can do the examples together. We can learn together. Okay. Now, what I'm going to do in this case is let's go to a stock just real quick. Like I'm going to pull this up. I'm going to just kind of look at something just real quick. Just want to see kind of what's moving out there. I'm going to go to a stock and I'm going to use example given MO. Now, when we talk about the strategy, Okay, when we talk about these strategies, such as a married put, married slash protected put, or a collar strategy, these are bullish strategies. Okay, what does that mean in English? That means we want the price to go up, but we don't know for sure what's going to happen. Now, by the way, you never do. So that's why there's different strategies. Now, the biggest actually thing is, if we take a look at this, if someone buys the shares of Altria, MO, they're thinking the price is going to go up. Okay. Now, let's show this and kind of walk through this. Now, as we do, there might be some questions arise. Ben's in the chat. I'm also going to be watching the chat as well and try to answer as many questions as possible. Now, if we take a look at this, let's imagine the investor says, look, I want to buy the shares of the stock, and I'm going to walk us through how we normally do it. Okay. So if I right click on the shares, right click on the chart, and now what I'm going to do is go buy custom, and I'm just going to go with stop. Okay, so that's really not bad. Now, this is normally maybe what investors do. I'm going to buy the stock, and what I'm going to do is I'm going to set the stop. All right, so now if someone did this and said, hypothetically, James, I'm going to set my stop at $68. Okay, so if they actually buy, example given, 100 shares, doesn't have to be 100 shares in this case, but that's what it defaults to. And they say, look, I'm going to sell those 100 shares and sell it if the stock gets at 68 or lower. And they're saying, I'm going to not have a day order, but a GTC, a good to cancel. Well, this is what the chart, this is what it normally looks like, right? The investor says, look, I'm going to get in. And what I'm going to do is I'm going to set that stop at, example given, $68. Now, let me put this in the paper money account so we could just kind of do this example. And now what I'm going to do is, and then what we're going to do is we're going to build up from there. Now, I'm starting with what you probably already do, okay? So I'm going to put it right here. This is exactly what we saw before, but I'm going to send the order. And now what you're now going to see is, this is buying those shares of stock. There's the stop, and this is what it looks like. And you're now going to see there's the 100 shares of stock. It hasn't filled yet. That's why the label's there. And now we see in this case that there's a stop, okay? So first off, if you said, James, I'm a stock investor, why on earth would I ever consider maybe something different than stops? We'll tell you statistically why, okay? Now, the biggest actually thing is if we go to the trade tab, okay? We go to the trade tab. Now, remember, I just kind of set a stop at, let's say, 68, okay? Now, this was shocking to me, but not shocking. If we go to the trade page, you're now going to see that if we look up at the very top, we see the stock information up top. And then on the left-hand side, we see the options. And if we look at the options, there's different options. There's different expiration dates and so on. Now, if I went down to the 21st of August expiration, you're now going to see that on the left-hand side, we have calls, and the right-hand side, we have puts. Now, what was the stop again we did? Assuming we just bought the stock and set a stop. We said $68. We don't have 68 in terms of the strike prices. The closest thing we really have to this in this case is 67.5. Now I'm going to tell you why you need to pay attention. Because probably the most frustrating thing about, let's say, the stock market is when the volatility goes up, it's not if it goes up, it's when it goes up. Okay. So when you look at this number delta 16, that's saying the odds of the stock closing below the strike price by a penny. Those odds, as of right now, are 16%. As of right now, that the stock will close below the penny, close below the strike by a penny. Now, there's also what's called the probability of touching. That probability of touching is usually 2 times whatever the delta is. And now what you're going to see is in the next 44 days, that's what that's saying, 44 days, okay? 44 days of what? 44 days until the expiration. And now what you're now going to notice is it's telling us what's the probability of the stock going from 73 down to 67.5, the strike price. The answer is 36%. So if we had 10 trades, okay, it wouldn't be a shocker in the next, let's say, 44 days that we would probably lose 36% of them. Wouldn't be a shock. Now, if the volatility really went up, could you even have a higher amount than that? Yeah, absolutely. Probably, yes. Okay. So that's what's actually kind of shocking is that's why some people don't like setting stops. Okay. They don't like to have that high of a likelihood of getting stopped out. Now, when you set a stop, if it goes down to that price or less, it triggers the the shares of the stock at the stop price or below that. We don't know where that's going to get filled. The nice thing about a protective put is if the stock comes down to the strike price, that does not mean the trade is over, like a stop potentially could be, because you have a right to sell it until expiration. Okay. And that's the difference. Sometimes we see these prices go down and they come right back up. Someone that had a stop could have had that stop triggered and locked in that potential loss or got out. Where if you had a protected put, you just had the right to sell it, and it's protecting what? The shares of stock. Now, if you chose something like example, I set a stop at 70, what is the likelihood of getting stopped out? The answer is 58.9%. So if you had 10 trades, dang near 60% of them could be stopped out in the next 44 days. Why is this point so huge? Because when you talk to people that are first in the stock market, they'll say things like, as soon as I put positions on, I feel like I get out. As soon as I put positions on, I get out. It's because they're buying in low volatility and selling in high volatility. Consider flipping that. Consider buying in high volatility and selling in low volatility. That's a major comment right there. So go back. Consider buying in high volatility and actually trying to sell in low volatility. Okay. How many of you get that? Okay. Don't worry. It took me a while too. Now, here's the deal. We're now actually going to go back and kind of talk about this. What does this look like when we do this? Now, if we buy the shares of stock and buy the put too. Now, remember, the first trade we did was bought the shares and set a stop. That's how we normally talk about it, okay? But if we said, no, I'm going to buy those shares of stock, click on the ask price, how do you actually buy a put together? Now, wait, is this a married put or a protected put? Well, we wrote down, let's go back to that. A married put is you're buying a stock and a long put, you're buying it at the same time, okay? Buying it at the same time. You're not trying to time it. Now, if we take a look at this, you're now going to see, well, how do you do that? Well, if we went to the trade tab, because we want to do a trade, we type in MO, fine. Then we go to the ask price right there, and that's just going to bring up that we're buying shares of stock. Now, one of the questions might be here in this case is, James, do you have to buy 100 shares to do a protected put or a married put? You do not. What is the minimum number of shares you probably need? The answer is 40, okay? 40 or higher. Why? That has to do with the put that you're probably considering buying. If we do a married put, we want the position to be overall bullish, okay? So if we don't have 40 shares of stock, that married put is probably not bullish, okay? So that's a concern. We don't want to do a 10 shares, 20 shares, because that position is probably not overall bullish when you bring into context that you also have a put as well. Now, a lot of times people say, well, James, this is so foreign. I've never done this before. Really? So when you bought a car, you just drove off the lot? When you bought a house, it's not protected at all? You bought a phone, $1,500, the computer, and it's just not protected at all? You do it. You just don't realize that you do it. Here, we're just doing it in terms of now stocks now. So step one is we're going to actually just buy the shares of the stock. We're going to come down to where it says single order. And we're going to say, look, do this in a sequence. Okay. Step one, buy the shares of stock. Step two, buy the put. Now, when we buy the put, the major difference when we do a buying of the put has an expiration. Okay. And that expiration that we normally look at is usually 20 to 50 days, the monthly options. Why the monthlies? Because there tends to be more liquidity there. Why 20 to 50 days? Well, the reason why we do 20 to 50 days is because we're just looking to have short-term protection. Okay. Now, if I now go to, well, let's go to the put side. What strike do we look at? Well, remember, if we buy those shares at 73.78, we're concerned the stock is going to go down. So the put that we buy is usually going to have a delta probability, okay, between about 30 to 40. Now, if I come to this and we look at the bid-ask spread, this is important here, okay? Very important. Do not assume that when we look at the options that they're all going to be equally liquid. That's not true, okay? You go to the grocery store, some products, some quantities of products just sell more than others. Same thing in the stock market, okay? Now, if I click on the ask price of the 70, what does it do? Well, now what you're going to see is if I did that, when I go first triggers SEQ, I click on that 120, and now it's going to bring up the second row. Now, this is not a protected put, okay, because we talked about that. This is a married put. We're buying the shares of the stock, and at the same time, we're buying the put. Now, let's just do the quick math, okay? So we're going to look at this position. If we buy the stock at 73.77, okay, and we have a right to sell the shares at 70. All right, now, can anyone actually tell me what the risk is on the stock position? Just basic math, not a trick question. Well, we have a right to sell it. If the stock goes down to 70, we have a right to sell, okay? We would lose 377 on the stock, okay? So if it goes down. Now, in this case, what you're now going to notice is if we go from 73.77 down to 70, we could lose 377, okay? Now, the other thing to kind of make mention of is the right to sell the shares. It's not free. So we need the stock to go up by $1.20 to break even. 73.77 is the stock price. $1.20 is what you're paying for the put. So at expiration, we would need the stock to go up to what price? Add them together. 73.77 plus $1.20. At expiration, we would need that to be the stock to be at 74.97 to break even, BE, at expiration. Okay, so at expiration. Okay, now type in the chat if you understand that. Step one, you're buying the shares of the stock. Step two, there's a cost of the put. If you add those two together, you get 74.97. Anything above 74.97, gravy. But at expiration, you need the price to be at least 74.97. Now, the comment now comes into, is it like when you buy the put, you're relating that really to, let's say, the cost of the stock. So if we paid $1.20 and that stock price that we bought the stock for is 73.77, we want to kind of see the percentage of that, okay? Now, sometimes people say, well, it doesn't matter what you pay for the put. This is where you push back nicely and just say, stop saying comments where you don't know what you're talking about, okay? Of course it matters, okay? It matters because, A, the investor's paying for it. Two, it matters because it changes the math of break even and so on. The biggest actually thing is if we look at this, we paid $1.20, $1.20, 73.77, it's going to give us a percentage. Now, if we're looking at, let's say, well, what is kind of lower, okay, we would kind of say between, let's say, 1 to 1.5. That would be, let's say, lower. Now, when you did that math, what did you do again? We did $1.20 divided by 73.77. Where's the $1.20 coming from? It's what's the cost of the put. If this percentage is between about 1 to 1.5, okay, it's probably like lower. And if it was probably, let's say, 2%, okay, we'd probably be thinking like more like medium. If it's probably 3% plus, man, that volatility is higher. And why does it matter? Well, because if we weren't paying $1.20, but we were paying $3, we would need the break even to be higher. And now it changes the probability of the stock trade being profitable. That's why it matters. So that's why we're looking for, let's say, positions where the volatility is probably between 15 and 24. Okay. Could it be 28 like this and still be pretty close? The answer is yes. Okay. Now let's actually do this. So what I'm now going to do is I'm going to come back. And now, by the way, the numbers we talk about don't change. Okay. These percentages we talked about for almost 25 years. Okay. Now here's the deal. Buy the shares of stock, buy the put. Here it is. I'm going to actually go confirm and send. Now, first thing, if you've never done a protected put before, welcome. Okay. Welcome to learning to protect your assets. Okay. Buying the shares of the stock and then selling the shares potentially. You have a right to sell the shares at the strike price from now until expiration. And there it is. This is the first married put. Now, the question we should ask ourselves is here, do we want the protection to become worth something? Do you want the protection to become worth something? What do you want to become worth something? You actually just want the shares to go up. You hope that that protected put becomes worth less. And because what you want is you want the shares of the stock to actually go up. But this is the protection in the short term. Okay, does that make sense? All right, now always remember that the protected put is only from now to expiration. Okay, always remember that. Now, the one thing I want to kind of just do just real quick is let's assume now, well, James, you talk about a married put, but wonder if you had the shares already and you said, hey, look, I'm a little concerned about a position I have where the price of the stock might be starting to go down, but I like the company, but I want to protect the shares. Now, wait, if I have the shares already, example given CSX, and I have 100 shares, example given, can we buy a put as well? Well, let's go check. So what I'm now going to do is going to go to the trade page, and I'm going to type in CSX. Now, the first thing that we're going to go look at is what's the volatility. Why do we say that? Because that's really important. Because if you're paying for them, you're mindful of what the cost is. The cost is the premium. Now, if I go look at, let's say, what that 20 to 50 days expiration, what is the volatility? It's about 28. You're going to see in this case. So that's first off. So that's telling us it's probably possible. Okay. The cost is probably that premium might not be as high as we thinketh. Now, if we said, well, what strike? We said a delta between 30 to 40. That is below the current stock price. Now, you're going to now notice that the bid price, $1.20 to $1.55. Now, if we did something in the middle here, let's say $1.35, what did we buy the shares for? $40.13. Well, if we paid $1.35 and we paid $40.13 for the shares, it's going to be about 3%. So it's a little higher. However, that's because we bought the shares 20% ago. Probably the way this is a good problem to have. Okay. Now, could someone still do that? They could. This one is kind of a little inflated because we bought it $8 ago. Mark is what the current stock price is now. The trade price, what you bought it for back then. So it's skewing that percentage higher. Noted. But wonder if we said, I just want to buy the put just in case. Now, have you ever heard a stock investor say, look, I set a stop and I'm going to lock the profits in? Can't really say that per se because you don't know what it's going to fill at. However, if we came in and said, look, I want to buy a put by itself and I want to have a contractual right, not theoretical, not a maybe, not a depends, a right, a contract. Well, all we had to do in this case is we're going to go to the 20 to 50 days expiration, check. I'm going to actually pick the strike that is closer between, let's say, a delta of 30 to 40, out of the money, meaning below, the strike price is below the current stock price, and that's going to be the 47.5. Now, if I go down to the mid price, that $1.38, we now have a contractual right to sell the shares at what? 47.5. Now, you might be asking the question, well, James, if you were that concerned about the put and if the stock going down, why don't you sell the stock? Guys and gals, if you sold your house every time the wind blew, every time there was slight rain, or hail, you would be living in a tent. Okay. You'd be selling the business every other month because the wind blew. And the same thing goes with the stock market. Some investors want to hold positions longer, use options in the short term to protect when volatility hits, and they're using those options in the short term. Now, we're going to go confirm and send. Now, notice this. If we buy a put after we already own the shares, what is this called? The answer is a protected put. So now what you're going to notice is a protected put could even be done when there's less than 100 shares, but we probably need 40. Okay? Now, in this case, what you're now going to see is we're going to send the order. Note the commission of 65 cents. And now if that position fills, we have shares of stock and we have some downside protection that lasts 44 days. Now, let's assume, I don't know what happens. 44 days go by. The stock is now below the strike price at expiration. What should happen? Well, if that stock closes below the strike price at expiration, the share should or could be sold at expiration because the stock is below the strike price, even if we were on a cruise ship in the middle of Timbuktu. Okay? So the biggest thing is anything that has intrinsic value, meaning below the strike price, could or should be exercised, which means those shares are sold at the strike price. Okay? Now, if we went back, let's kind of show a different example. Now, there was a question regarding, okay, and I'm going to kind of show this. There was a comment regarding some of those oil stocks we talked about from last week. Some of the oil stocks we talked about from last week was PSX. We talked about, for example, MPC. Okay. We also talked about Valero, those three main horses. Now, if we come, so we talked about what is a protected put. We talked about what is a married put, the difference, the timing difference. And the biggest actually thing is, let's kind of take that next step. Now, we know that when you did, let's say, a protective, when we talked about protected puts or married puts, we needed shares of stock. That's true. On a caller strategy, the difference between a protected put or a married put to a caller, we need 100 shares. When we talked about buying, shares of stock. That's the same with the caller. The difference is, okay, we did the stock position, stock plus the put. But in this case, the number one reason that I've seen over all the time of doing this, well, James, I have the stock, but I don't want to buy the put. Why? Why don't they want to buy the put? Got to pay for it. Okay? Got to pay for it. Now, is there any way that the investor might do something to maybe help pay for the put? Well, yeah. Now, if we went back to this, let's do this. Now, what I'm going to do is I'm going to use an example given of Oxy. Okay? Now, Oxy is one of those that's had a pretty good move back to the upside. And remember, if you did a married put, protected put, or a caller, it doesn't matter. They're bullish strategies. You want the stock to go up. On the married put, protected put, you have unlimited upside potential. Unlimited. But you define the risk of the downside because you have right to sell. Now, if we talk about the caller strategy, what you're now going to notice is we're still going to buy the shares of stock. Let's kind of walk through that. Step one, we're going to go to the trade page. We're going to click on the ask price. Now, if I click on the ask price, let's show a diagram of what this looks like. If I right click on this green line, we're going to go to analyze trade. This is going to show a diagram, a profit loss diagram of what this position looks like. Now, this looks way more complicated than it actually really is. On the left-hand side, we see that there's the dollars on the left-hand side. Okay? The profit loss. Okay? On the bottom, this is the stock price. And this is where we are right now. So obviously, if we had 100 shares of stock there, if the stock goes up $1, well, the stock goes up $1, we have 100 shares of stock, that we should be up $100. If the stock actually goes down $1, then we should be down $100. And that purple line is just showing the profit loss diagram. That is not that bad. Okay, that's all that line is showing. So if the stock goes to the right, it's up. Stock goes down to the left, it's down. Now, let's kind of show where this is different. Well, let's build on what we just did. If we said, hey, look, I want to buy a put like I did before, we're now going to come down to that delta 30 to 40 or so. If I chose the put, now remember, if I did this, what do I need to do? Well, I'm going to come down to where it says advanced order, single order. I'm going to click on first triggers SEQ. So what happens, James, if you have some stocks that might be energy based or technology based or discretionary and they are more volatile? Welcome to the world of callers, okay? So what you're first going to notice is the volatility on these are higher. Why does that matter? Because the volatility is higher, the put's higher, okay? And that's probably the number one reason why people don't buy puts sometimes is they don't want to pay for it. Well, is there any way that the investor could do this and help use something to pay for the put or help some of it? Well, if we take a look at this, what I'm going to do is I'm going to click on that strike with a delta 30-40. We already talked about that. Let's build on what we did. That's what it looks like. We just did that, right? Well, let's show what this looks like on the diagram, and you tell me now what's happened. Now, remember, this right here is a married put, buying the shares and buying the put at the same time. Notice now that that line is now not just keep going down, 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 down. I'm going to tell you right now, not everyone should do options, but if you would consider this, if someone said, what's the one major reason why someone uses options? They want to define the risk. They want to make it where the risk is not all the way down to the zero on the stock. That's a major one. The second one is they want to make it where the movement in the profit loss is not as high. Have you ever had a time in the stock market where the market is more volatile and you said, geez, I wish I could handle those turbulence in the price movement and just not be at as much risk? Welcome to puts and callers. That's why people use them. Now, what we're going to do in here is, notice this, this still has unlimited upside. Well, now what we're going to do is that the investor said, yeah, I'd consider buying that put, but I don't want to pay $195. Now, wait a second. If we had 100 shares of stock, what could we do with that? You know exactly where this is going, okay? Well, if we got 100 shares of stock, we could sell something. Sell what? Sell a call. And if you sell a call, you're agreeing to sell your shares from now until expiration. You wouldn't do it for free. You're saying, give me the money. And you're saying, give me that premium. Now, if we look at, let's say, hey, I'm going to sell that call with a delta of 30 to 40, just example given, that's going to be, in this case, about what we paid for the put. Now, when you pull this up, we click on that $1.94. There is your caller. Now, wait. Did I do this right? Are we buying the call or are we selling the call? Nah, we're going to sell the call. So we want to, in this case, we want to buy the shares of the stock, which we're already used to. We're going to buy the put for downside protection, and we're selling that call. That's giving us a cap on the position. Now, here's what's kind of nice about this, okay? You're now going to notice that these are pretty much offsetting each other. And what I'm going to do in the last 2 minutes, and this is very important, draw the diagram. Do not skip the diagram. 54.50 is where we're buying the shares of stock now. We have an obligation to sell the shares at 57.5. What's the upside potential? $3. Okay. What's the cost when you look at the put and the call? I'm going to pretty much say they're an offset. Where do we have a right to sell the shares? At 52.50. How much risk is that? -$2. Now, if we look at this math, if the stock goes up and closes above that 57.50, we make $3, or in other words, $300. If the stock actually goes down to 52.50 and closes down there, we lose $2, or in other words, $200. So here's what's kind of so nice. Even if the stock went to zero, you still have a right to sell those shares at 52.50. Okay? Now, if you kind of get so concerned about the day-to-day, market's up 300, the Dow, they got to remember the Dow's at 50,000, so 300 is not that much. But if you said you're so concerned on a day-to-day basis, you might say, look, I'm normally going to buy shares anyway, but maybe I'm going to collar some positions, okay? And that way I don't have to be so concerned from a day-to-day basis because A, I have a defined risk, and second, the position is not at as much risk for with a day-to-day fluctuation of price movement. Okay, so in summary, would you consider being interested in trading stocks already, maybe even ETFs if you would, and then having defined risk? Would you consider that? Second, when there is volatility, would you consider a strategy or strategies that actually taper down the profit loss movement? And what you'll probably find is many investors, not all, they might say, James, I'd kind of be more interested in that. Now, the one thing I want you to kind of remember is we'll follow through on this more tomorrow on the trend trading class. So if you said, I'd like to kind of learn more about this, where can I learn more about this? Well, let's go back to this. So I'm going to teach a class tomorrow, Trading the Trend. Now, if you said, well, can you send me that link? I sure can. And what you're now going to notice is, don't forget. So if you said, hey, where can I see that? I'm going to copy and paste that right there. Join me tomorrow. So if you said, hey, I'd like to learn more about this, can we practice more together? Sure, join us tomorrow. Now, coming up next, we're going to actually have a class. Let's go back to that next class, going to be right at the top of the hour. And if we did this, let's do this. Now, by the way, the next class is going to be on managing an options portfolio with Brent Morris. I want to say thanks to Ben Watson for answering those questions in chat, and thanks to all of you as well. Your homework is to go out and practice, really a married put and a caller example. Now, remember with what we talked about, you can also subscribe to the Trader Talk channel. Do so. It's free, okay? Learn more about kind of some of the things we talked about on a live format and recorded. Remember that all investing involves risk, and this has been the class on trading growth and value with a special topic of protected puts and callers. With that said, take care. I'll see you back tomorrow, and stay tuned for Brent Morris right at the top of the hour. Take care. Bye-bye.